I gotta go ahead and start recording right now. I'm delighted to share this session with you. It's one of my favorite topics. We're going to go through 5 things today. First is what I call business simple, and that's the basics of business growth. And that's going to really tee up our guest today, who's got a brilliant company, and they're one of our strategic partners. And he's going to go through financial management basics and how do you build off of the basics of business growth to really understand how your business makes money. He'll also talk about the difference between insights and reports. And then I'll pull together some of the pieces that he talks about and bring together what I consider to be Nirvana, which is purpose and profits really coming together. And then I'll answer any questions that you have about ShiftCo, and we'll go from there. So as I mentioned, Terri Maxwell, about 12 years ago, I had this huge awakening, and I sold the business that I had at the time, which was about a $7 million a year service business, and started all over. And said, if I want to really focus on making the world better, and I began this idea that I could reinvest in purpose. And I started the equivalent of a purposeful Shark Tank. And we started launching concepts. So Succeed on Purpose and Ignite on Purpose, and then Promote on Purpose and Talent on Purpose. So we had 4 concepts up. And some of my clients of those businesses came to me and said, we need to turn your method into a business growth community. And that's basically how ShiftCo was born. But the piece that's fascinating as I've gone through that is I had some insights and lessons along the way. The first is that you can actually make a difference and make money, and they're not mutually exclusive. And a lot of times we think that I can make a difference and do good in the world or make money, and you can do both. And our guest speaker is somebody who's done that. Second is a purposeful business has to earn money in order to make a bigger impact. And I struggled with that in the very beginning. I was used to growing companies and making money. And when I made the pivot over to doing both, I really struggled with the idea that, how do I actually make money and do good? And so you really do need both. And then fourth is purposeful businesses evolve as much as they grow. And those lessons resulted in something that's now called the Conscious Business Growth Platform. And these are the business phases, and the business really grows as I evolve. And each phase really requires me to learn new things. And one of the most important things that we have to learn is how our business actually makes money. That's the key. Here's an example of what that looks like. And I call this business simple. A lot of times our business looks like this purple line, and it doesn't occur in a straight line. And it feels like get the work, do the work, get the work, do the work, get the work, do the work. And it shouldn't look like that purple line. It should look more like this until we get around 30,000 a month, 50,000 a month. The business should look more like the green line. But if it looks like the purple line, what that means is something is off in this fulcrum, which I'll talk more about. And then once you stabilize the fulcrum, the business looks like this. So you start having those dips, and it starts to feel like climbing stairs. And so how do you create that? How do you make it so that your revenue and profit start to look like this green line where it's like climbing stairs, and it's not that loop thing? Well, the key to that is what I call the fulcrum. And Business Simple is about managing supply and demand. And to make a bigger impact, the first thing you've got to do is scale the business profitably, which means you have to know how the business makes money. And that's why I wanted Giuseppe to talk with us today, is we've got to understand how our business actually makes money. And it's not as easy as get the work, get a check, do the work. It's not that simple. There's a lot more that goes into it, which Giuseppe will be sharing with you today. So that's the first thing. Secondly, is to scale the business profitably. We then have to automate demand generation. So we've got to know how we get new business. And the more systematized and automated that can be, the faster the business grows. And then once it's automated, you then have to make sure that you can fulfill the orders. So whether that's building a product or adding resources to your team on a contract or full-time basis. You've got to make sure that you bring those two together. And the key to Business Simple and why Giuseppe's training is so important is this Fulcrum is like a seesaw. If you're familiar with a seesaw, there's that little thing that sits right here on the seesaw. Well, that's called the Fulcrum. And that Fulcrum has to be balanced for the seesaw to be balanced. Or you go through this, I've got too much work, I don't have enough work. I have too much revenue, I don't have enough revenue. And the first most important step to balancing the Fulcrum is understanding how your business actually makes money. So this idea of how your business makes money is really, one of my quotes that I'm known for is earn from your mistakes, don't just learn from them. And one of the mistakes that I made, both in my first business that I launched in 2002 and when I became a conscious entrepreneur, is I didn't understand how my business made money. I understood how it generated cash, which is get the work, get paid. That's how your business generates cash. But that's not how your business actually makes money. And the notion of if you want to be financially free as an entrepreneur, you have to understand not just how your business generates cash, but how your business actually makes money. So I want to bring together somebody that I actually admire. I've got a CEO crush on him. He's built a brilliant business model. I think it's going to be game changing. Giuseppe, tell us a little bit about Varo Team, and then tell us a little bit about financial basics and how your business actually makes money. Giuseppe?
Sure. Yep, I'm here. So nice to see everyone. Thanks for coming. My name is Giuseppe Salamone. I am one of two co-founders with Varo Team. We are a virtual accounting firm that handles day-to-day accounting operations for small to mid-sized businesses. We also do CFO services and tax services as well. So it's an all-in-one, one-stop solution for small to mid-sized businesses to get access to resources that they need. Our focus and emphasis is on efficiency and technology. So, there's hundreds of software options out there when it comes to your finances, especially in small business. What is the technology that's right for you? So part of our job is to make sure that you're in the right tech stack, that it's been evaluated by us, and that it's working the way that it was intended to be used, so that you're efficient and that you're set up for success as you grow. So you can go to the next slide, Terry. So we're going to talk about financial management and the basics. And the first thing that I wanted to just drill down on a little bit was the comments that Terry made about how does my business make money. One of the most common mistakes that small business owners make is that they believe that cash equals profit, and cash does not always equal profit. There could be a variety of reasons why you have cash in the bank. It doesn't necessarily mean that you're making money. So you could be sitting on a line of credit, on a loan, which means that you have cash in your bank, but your business is actually losing thousands of dollars a month, and you're burning through that cash. Hopefully you're using that cash in order to correct the profitability problem, and you're going to start growing the business. But rule number one, never assume that because you have cash in the bank that you're making money. So the first thing that you need to do is you need to make sure that you have a solid set of books and that you're maintaining that on a regular basis, constantly looking at and evaluating where you're at. There are two types of accounting, and I'm gonna just touch on that for a quick second before we move on. There's two types of accounting. There's something called cash basis accounting, which I'm sure you've heard before, which is money in, money out. So when you bill a customer, you recognize that you've earned that money once the money hits your bank account. So once they've paid you and it's been deposited, that's when it's recorded as being earned, right? When you have expenses, same thing. You might have a bill today that you don't pay for 2 months from now. It's not recorded as an expense until you actually make the payment and the money leaves your bank account, right? So typically tax preparers will use the cash basis method. It's usually more advantageous to you to do your taxes in cash basis. However, cash basis does not provide you with an accurate picture of the financial health of your company. The other type of accounting, which is GAAP, generally accepted accounting principles, is known as accrual basis accounting. And in accrual basis accounting, you're going to recognize your revenue as earned the minute that you bill your customer. So when you send them an invoice, the invoice is dated, let's say, today's date, and you bill them for $2,000. They might not pay you for 2 months from now, but you recognize that as income the minute that you send that out, right? Now, let's say another example in income to make it a little bit even more granular. If you have a service that you're providing to your customer and you're billing them for 3 months at a time. So let's say that you're billing them $500 a month, but you send them an invoice for $1,500, okay? Well, $500 is attributed to this month, March, 500 is attributed to April, and 500 is attributed to May, right? So when you send that invoice, there are accounting methods that you can take by booking that to what's called the balance sheet, which is one of the financial statements, and then moving that money out as earned income as the months pass, right? So that way the $500 that you're earning each month is being recorded in the correct period. Now, on the other side, on the expense side, it's the same thing. Expenses are recorded at the moment that you incur them. So let's say, for example, I'll use payroll as a good example. I pay my employees on the 1st of the month for the second half of March, right? So for the wages that they're earning on April 1st, that's what's going to hit my bank account. Those wages are actually an expense for the month of March, not April. So what I have to do is I have to accrue the expense in the month of March, so that way it's lining up with the revenue that was earned during the month. So this is what's called the matching principle in accounting. So you're matching your earned revenue with your actual expenses for the same period. What that's going to do is that's going to give you a better picture of the financial health of your company. So you'll be able to see, instead of the spikes and falls in your revenue, right? You're going to see an accurate accounting of what is your actual profitability over time. If you were to just recognize those things in cash, right, they wouldn't be lining up. So you might see in the month of March this huge profit, and in the month of April this huge loss, right? And so what you're trying to do is line up the revenue and the expenses so that you are seeing what your true earnings are during that month. So this is one of the things that we talk to people about. What do I need to do? You need to set up a solid set of books. And if you are able to work with someone who can give you a set of books in accrual basis accounting, or if you're skilled enough or savvy enough to do it yourself, we always recommend that you start your books in accrual basis. It's very easy to go from accrual to cash for the purpose of your taxes, but it's much more difficult to go from cash to accrual if at some point in the future you need to make a change. Also, side note on accrual basis accounting, if you ever scale, if you ever have interest from investors, if you are ever seeking a bank loan, they are not interested in cash basis reports. They want them in accrual. So you want to make sure that this is something that you're easily able to have access to down the line. It might not seem important now, but it'll be important later. And then it's much more costly of a venture to get it to go from cash to accrual at a later date.
And Giuseppe, I just want to echo that. I pride myself on having been a former English teacher and didn't get very far in math. And so when I became an entrepreneur, I just didn't want to learn, this stuff like accrual, cash, I don't care. And then when I started my first business, we almost went out of business in the first 90 days because of the accrual to cash. the customer paid us up front. And so it was a $30,000 project. I put the $30,000 in the bank and I'm like, woohoo, I got tons of money. And then the bills started coming in from the folks that were helping do the project. And there was no other revenue coming in, but the bills kept coming in. And so this whole time I'm thinking, oh, I've got plenty of money, then I'm writing a $4,000 check and then a $6,000 check. And I'm like, still got plenty of money. And we had only paid for 25% of the project. And I thought I had cash. And again, now obviously I'm a lot more sophisticated. I don't make those silly mistakes, but as an entrepreneur, this understanding the difference between accrual and cash is how you understand how your business actually makes money. So I want to emphasize the pain of having learned that lesson the hard way and why it is so important to really either develop enough of the expertise yourself or partner with somebody that has that expertise, because you've got to know your budget for your costs, as well as you might have a virtual assistant on your team. You might have some tools that need to be purchased. And if you don't have that budget, like Giuseppe is saying, because you're doing everything on a cash basis, you're not going to have planned for those costs. And I made that mistake. And literally my first solo business that I started in 2002, I almost put myself out of business in 90 days for that very reason. So I don't want to steal your thunder, but I just personally have lived that pain.
Yep, for sure. And I've seen it countless times in other businesses, not understanding the value of seeing and understanding that. And I can also say too, that sometimes no matter how important I emphasize it is or how I explain it to people, there are some that just will never want to take the advice, and they'll see a short-term cost savings and they'll go for that, which can lead to very costly problems later. I'm a really good example of costly problems later with my IT, right? I made a decision thinking, oh, this is going to be easy. I'll do it this way and I'll save money by doing this. And now it's like a $15,000 mistake that I'm fixing later with my IT company because I made a really poor decision when I first started out. But costly mistakes, as Terri said, are really important to make as long as you don't make them again, right?
You earn from your mistakes, right?
Exactly. So the keeping your budget top of mind is obviously the next thing. So if you don't have a budget, you should sit down and develop one. Think about and make assumptions about what your revenue is currently and what it's going to be or what you think it's going to be. Be realistic. Think about who's in your pipeline, where your sales leads coming from, and whether or not you think you're actually going to realistically attain that goal. Now, at the same time, going back to the accrual basis discussion that we just had, when you start thinking about your expenses, you have to think about what are the expenses that you're going to need to incur to generate that revenue. So for example, Terri mentioned that she had a $30,000 project and she had subcontractors working on the project that she needed to pay. So do you have subcontractors? Do you need to buy a software that needs to be used in order to deliver the services? What are the different types of overhead or things that you might need to buy in order to generate that money? And then aside from those direct costs that are associated with the revenue, what are your regular operating costs? Are you giving yourself a guaranteed payment or a salary? Are you paying an assistant that's an administrative assistant and not working directly on the other type of work? Have you hired a professional like a lawyer or an accountant? What are those things? Start thinking about it, thinking about the timing of when those payments go out, and build out your budget. And you want to do a budget that's a month over month. So you want to build something that's January through December, a budget for each month of the year that rolls up into a total for the year. Write out your assumptions. Put it in a tab in the Excel so that you can refer back to it. So when you start inputting numbers into the budget that you remember exactly why you projected that you were going to be at $15,000 in monthly revenue by Q2, right? You actually had it listed out. Well, client prospect A, B, C, D, I was going to convert by that date, or whatever the case may be. And then in the next thing that you need to think about is not taking shortcuts. So we talked about doing your books. We talked about developing a budget. These are things that seem like a real drag on you moving forward in your business and not focusing on the reason you got into business in the first place. But not doing them and taking shortcuts and throwing together some mediocre spreadsheet at the end of the year for your tax preparer to use to just prepare your taxes is really selling yourself short. You're not getting a good picture into the financial health of your business. You're not noticing when you're being charged for things that you shouldn't be. And you're not staying on top of how profitable these individual projects that you're billing out actually are. And so you want to make sure that you do that. The budget is really important because it helps keep you on track and make sure that you're moving towards those goals. So that would be like, a really solid set of advice is if you're not willing to do the books yourself, or if you're not able to, right, because you just don't have the skill set or the time to learn, work with a professional firm that understands what it is that you're doing and can produce those reports for you. There's a communicative aspect to a relationship that you have with a bookkeeping or accounting firm. So you need to be in contact with them, and that can vary in degree of communicability, right? Where you're communicating with them via email only, or you're doing it through monthly meetings or whatever it is, depending on what your level of need is. But you want to make sure that you're keeping them in the loop if you're going to hand it off to someone to do that. So then the next thing is to make sure that you're consistent. So consistently updating your books is very important. So making sure that you're updating the bank feeds every week, that you're looking at the transactions that are flowing in and out of the bank account. Also making sure that if you've committed to reviewing your financials monthly, that you're actually doing that, sitting down, having a meeting with self and going over and understanding the reason why behind some of the numbers. So, if you see a dramatic drop in revenue from one month to the next, can you explain to someone who doesn't know anything about your business the reason why there was a drop off? Or why there was a spike in insurance expense from one month to the next? Maybe you changed your policy, maybe you renewed something. So consistency is really important. And then also consistency in the numbers, right? So one of the things that we always tell people to do is when they're looking at their financial statements, always review your profit and loss month over month and look for consistency in the numbers, right? So you can evaluate that profitability. You want to make sure that if there are any spikes and valleys in your income and expenses, that you understand the reasons why there are spikes and valleys, right? You're looking for a consistency. So if I'm seeing that you're consistently billing out $10,000 a month in services, and then all of a sudden in 1 month it jumps 20,000 or it falls significantly, it jumps 20,000. My question as a professional to you would be, did you acquire a new customer that's going to pay you $20,000 a month, or did you pre-sell a bunch of services? Did you sell something, months in advance where you made a sale where it was like they're going to prepay you for 6 months of services up front? Because then that accrual basis accounting comes into play, where that needs to be moved off of the P&L and onto the balance sheet and then moved out each month, right? So you want to evaluate your profitability. So you want to understand, you can even get down to the project level where you're looking at what are the direct costs associated with this individual project, what is the revenue earned from that individual project, and then what's my profit margin, right? So you can determine whether or not it's profitable, because I can't tell you how many times that I've seen small and mid-sized business owners go out bill these huge amounts for these projects, but then when actually all of the direct costs associated with that project come in, they've actually ended up losing money on the project. So what was the reason that you lost money? Was it that you underestimated your cost? Was it that, and you priced wrong? Was it that something happened within the project that was unexpected and you didn't feel comfortable going back to the client to ask for a revision in the agreement because of some extenuating circumstance that came up? So those are the questions that you would want to ask when you're evaluating your profitability.
And that's that point that I mentioned. You've got to know how your business actually makes money versus generates cash. And again, I think you're hitting the nail on the head, Giuseppe, and it's critical.
Yep. And then the other thing that is critical when we start talking about cash is to remember your receivables. So I can't tell you how many times, when you're first starting out and you're scaling your business and you don't have a lot of help, you wear all these hats, right? And one of the hats that you wear is you have to collect. You have to collect money from your customers. And some people are really good about it and some people are not, because the real reason that they're in business is what they're focused on, right? So it's very easy to forget that piece and to like look at your receivables and know if people have been paying you and paying you on time. So you want to make sure that you make a commitment to yourself to review this on a regular basis. I look at my receivables at least once a week to see where I'm at and keep that up to date. There has been times when we've gotten so busy and I've fallen behind myself, even me as a professional, where I didn't look at the receivables for a long time. And then payroll came around and I was like, where's all my cash? And it's like, oh, well, there's $20,000. I've automated that now, so that's not a problem anymore, but there's $20,000 that I need to collect. And I've seen it happen with other small business owners, right? And that's one of the reasons why they hire firms like us to manage their receivables for them, or they take care of it on their own on a regular basis, and they make that commitment to themselves. Finally, you want to look at controlling your expenses. So circles back to the whole budget conversation. Having a budget, understanding what you've committed to spend and sticking with that is really important. Also, when you're doing the review of your financials on a regular basis, you'll be able to identify and see if you're being charged for something that you had intended to cancel, that maybe you need to just go back and get rid of. And if you're not looking at it, you won't be aware that that's happening and you'll just be spending money for no reason. So make sure that you keep a close eye on your expenses. I think that sometimes there's a little bit of an overemphasis though on controlling your expenses. You definitely want to control your expenses and you want to keep a handle on them, but you don't want to control your expenses to an extent where it's limiting your ability to expand or grow your business. So sometimes there needs to be more emphasis on growing revenue than there is on controlling expenses, right? You have to find that balance. Go back to what Terri said about the fulcrum. There has to be a balance between controlling your expenses and finding more revenue. And I'm usually the one that's in favor of finding more money versus trying to control those expenses, especially when I have initiatives that I know need to move forward in order to generate more profits. So.
And that's an excellent point. Very rare do I hear accounting professionals say that, so I'm happy to hear you say that. It is a balance because you can control your expenses and sniff out your growth altogether. Conversely, you can grow unprofitably. And I know, Giuseppe, you've seen people where that's happened, where they're growing their revenue, but they're actually growing in an unprofitable way.
Yes, for sure. And I've actually seen, I've seen this happen multiple times where there's been, problems in their operations or their processes where they're spending money on things that could be fixed with automation. So, controlling your expenses doesn't always mean like, oh, just cut that out of the budget. It also means like making processes more efficient, which can drive down costs. So thinking about it in that way as well is something really important.
Awesome. Talk a little bit about the really looking at reports from a different way to really pull out insight so that you can make good business decisions.
Yeah, so going back to what we were talking about on the last slide, you want to make sure that you've committed to reviewing your reports regularly. And, I already spoke about this, but I'll touch on it again. You want to make sure that when you're reviewing your report that you're able to explain what's being seen. So doing an analysis of month over month, what are your income and expenses? So you're comparing a prior month to a current month or several prior months to a current month is really important. And can you explain the reasons why behind the numbers things are going on? Why is there a spike? Why is there a valley? And maybe there's an error in the books. Maybe you forgot to bill for something that you should have, or maybe you put something into the wrong period or associated it with the wrong project. So you want to make sure that you're looking at and understanding those numbers to make sure that that's there. But then also you want to make sure that if you're looking at things on a project basis, which I mentioned before, that you understand the reasons why a project in particular is going over or under budget by significant amounts, right? So if you budgeted X, Y, and Z, and you're going way over, as I said, was there unforeseen circumstances that occurred within the project? Should there have been a conversation between you and your client to up the charge that you were charging because of those unforeseen circumstances? Did they ask for something that was out of scope that drove up costs? That's something that you should also be questioning. And then the next thing that's up here is knowing your cycles. So this goes back to the whole, looking for peaks and valleys, but that's when someone says that they want you to know what your cycle is. So maybe you're an online retailer and you're selling products online, and maybe your sales spike towards the end of the year because people buy your product for Christmas presents. Okay, so, or, Hanukkah presents or whatever. So you've got to know that that's what's expected towards the end of the year, and that's what's driving the spike at the end of the year. And maybe you're another type of business where your low season is over the summer months, or maybe your high season is over the summer months. Maybe you're a pool where people come and like a swim and people pay for memberships over the summer. So there's this huge surge in membership fees over the course of the summer, and then it falls off in the winter because you're in a colder climate. So knowing what your cycle is really important. And obviously you would know best as to what your cycle would be. When people are interested in your product, and the longer you're in business, the easier it will be to see what your cycle is in your numbers. And then the next thing that I mentioned is understanding your variances, which we already talked about. And then the next one is setting non-financial KPIs against financial data. So a KPI is a key performance indicator. So it's basically a metric that you use in order to measure how well your business is doing. And a non-financial KPI is essentially exactly what it sounds like. It's a measure that you're going to use, that you're going to put against the finances. So for example, if you're a membership-driven organization like ShiftCo, you might be putting what is your total number of members against your total revenue for the month. So you can look at what your per member charge is, right? And where do you want that number to be? Maybe you have a mix of memberships with different types of membership, and you want the average of those memberships, your member mix, to be at a certain dollar amount. So you can calculate that by taking non-financial data like membership numbers and putting them against the financial data that you've compiled in your books. And then finally, you can use that information to make informed decisions about your business. So back to the whole idea of the membership charge and looking at an average of those charges, maybe you're undercharging for your membership. Maybe it's not equaling cost, and those non-financial KPIs might, help you. There's also financial KPIs that you can use as well, where you're looking for a certain ratio or you're looking for a certain profit margin. Those are financial KPIs, and you want to set those and understand when you're hitting them and when you're not hitting them and why you're not hitting them. And if you are exceeding, maybe there's something that you're doing differently that you should do more of. And these are the types of things that you can use to make more informed business decisions and continue to grow your business.
Awesome, Giuseppe. I'm going to go back to the Fulcrum for just a second, and then we'll see if anybody has questions, and then I'll move forward and we'll talk about conscious entrepreneurship. So this idea of the Fulcrum, you're constantly managing supply and demand, whether you're a solopreneur, a micropreneur, a small business trying to scale to 1 million. You're always going to be managing this fulcrum of supply and demand. And the first thing you've got to understand is how your business actually makes money, not generates cash, but makes money. Otherwise, you'll constantly get stuck in this get the work, do the work, get the work, do the work, and you'll never really develop any financial freedom. And as you know, SHIFCO exists to help you change the world and make great money so that you're financially secure and financially free. And if you don't understand how your business makes money and actually generates a profit, the rest of it really doesn't matter. Second is to scale then profitably. Once you know, if I do X, I get Y in profit, not cash. To scale profitably, then you have to automate demand generation. And like Giuseppe said, you don't want to cut your costs so much that you're not actually able to generate demand. Then you've got to make sure that once demand generation is consistently coming in, you then have to make sure that you have the resources, whether it's physical product or people resources, to actually grow the business. Now, before we talk about conscious entrepreneurship, I want to see if there's any question for Giuseppe. He's truly an expert, and he's one of the few financial experts that can actually explain things that everyday people can understand. Are there any questions for Giuseppe before we talk about conscious entrepreneurship? All right, Giuseppe, just hang out just a little bit, and then I'm going to talk just a tad about conscious entrepreneurship, what it is, why it matters, and then we'll share the generous partnership that you have with SHIFCO. Conscious entrepreneurship is not rocket science. Conscious entrepreneurs at their core ask very different questions, and Giuseppe is one of these, so I know he can relate to it. They don't say, will someone buy it? They say, can I actually solve a problem? Is what I'm building, will it solve a problem? That distinction seems on the surface, well, of course, well, you'd be surprised how many entrepreneurs that I come across that all they're focused on is, will somebody buy my product? They're not really thinking about how it solves a problem. Secondly, when it comes to pricing, conscious entrepreneurs think in terms of value. How much is this worth? They don't say, how much will someone pay, or how much, money can I rake in? They're really saying, how much is this worth? Because they want to strike that balance. And then third is conscious entrepreneurs focus on, how can I make a difference? And they definitely want to make money. And that sometimes is where the rub is, which is why we have the partnership with Varo Team, is we want our members to understand how you actually make money from your business, because that money that you're generating is how you'll make a bigger impact and how you'll make a bigger difference. So how do you know if you're a conscious entrepreneur? You're asking these different questions. I've been researching this space for over 10 years, and there's actually 4 different types of conscious entrepreneurs. Most people start where I did, as a purposeful entrepreneur, that my business idea was generated out of the work itself. That's where most of us start. At some point, we start to migrate, as I did, and we become what Dina calls a heart-centeredpreneur. A heart-centeredpreneur is the work and the people they serve creates the meaning. And I know for me, as well as a lot of other folks, I get up every day thinking about SHIFCO members. I go to bed thinking about SHIFCO members and thinking about, how can I help you grow your business? It's because the work that I'm doing is important, but you are important as well. And that's typically the second phase that we see. Now, at these other levels, some of us are born to scale. And we have about 20% of our member base that they're focused on scaling. And the folks that want to scale are thinking on a macro basis. So the impact that they're thinking about is more, I want to shift industry. I want to shift society. I want to make a bigger impact. The meaning is still important to them, but it's that bigger impact. Social impact ventures are in the upper left-hand quadrant where the work is meaningful and they're trying to shift industry and society. And typically a social impact venture is a public benefit corporation or a not-for-profit or an LC3 or something like that, where they're really trying to, their venture is designed to create social impact. And then you've got the type of brand that most of my companies are now, that they're mission-driven brands. So and Shifco is a mission-driven brand. The work and the people both create meaning, and they're trying to create a macro impact in some way, either industry or society. So part of what's important from a financial standpoint, if you're a purposepreneur or a heart centerpreneur, I would encourage you to really quickly figure out, how do you partner with someone, a CPA, an accounting person, someone like Varo Team, to get the financial pieces out of the way and to get the help to understand how you make money. And let me tell you why that is. If you're a purposepreneur and a heart centerpreneur and your business starts to make money and it starts to grow because you're making that impact, if it doesn't grow profitably, what will happen is you'll never really be able to make that shift on the impact side. You'll never really be able to achieve that next level, shape to build to evolve. If you remember that from the Conscious Business Growth Platform, your impact will be severely limited because the business doesn't actually make money. And I can't tell you how many times I've had people come to me to invest in their business or come to me as a Shifco member, and I'm like, send me your financials. And I look at their financials and they're not actually making money. They've got cash that they're generating, but they're not actually making money. And that's not scalable. You've got to understand, to really make that bigger impact and to grow beyond a solo micropreneur basis, you have to understand how your business makes money as well as generates cash. So, I'll end with this thought, as a conscious entrepreneur, your business grows as you evolve. And part of what has to evolve is you have to understand how your business makes money. Now, you don't need to understand debits and credits and GL codes and all of that, accrual versus cash. You don't need to understand that. But what you do need to do is to know enough that you can converse with the partner that you're working with. Our partnership with Varo Team is one of the most important partnerships that we have, because this financial side to your business is more important than you think it is. You can't stick your head in the sand. And I'm saying that as a former English teacher that almost put myself out of business in 90 days, is you have to understand the numbers. So we partnered with Varo Team for 3 reasons. One, they really know their craft. Secondly, they scale all the way from solopreneurs all the way up to people that are raising capital and that type of stuff. Secondly, is they know how to make the complex simple, that scalability that they have with just the ability to speak plain English. And then third is their heart. They have a conscious heart. They really are trying to shift industry and society when it comes to their practice. So the partnership, anybody that is a Shifco member, we don't take any revenue from our partnerships. You get a 20% discount on the setup of any of the setup costs, which they don't do that very often. They waive the actual setup fee. No one gets both of those. You also get your first month free. Nobody, I believe, has that. So if this is something that you think would help you, you can reach Giuseppe. I'll give you an example, just a second, Anthony. I have several of those. You can reach Varo Team and Giuseppe and his team from the partner page, and the partnership discount and the link is located there. Anthony's asked a great question. Please give an example of how you determine how a business is making money versus generating cash. So Giuseppe, I'd love for you to take a swing at that, and then I'll add a few battle scars in that arena.
Yeah, there's a couple of different ways that you would look at it, right? So there's the first example, which is one that Terri brought up, which is that someone has prepaid for a project, a huge sum of money, and then the expenses are coming in after the fact, right? So she generated a huge amount of cash up front, right? And then the profitability of that was quickly diminished and overtaken by all of the expenses that were incurred later, which you could probably clearly see in her financial statements, which were in cash basis versus accrual. But if you had accrued those expenses early, you would have known that a lot of that money was going to be gone, right? So that's one. Number two is another example, which is one that I brought up earlier, is I have, for example, I have one of my larger clients in New York City did an investor round, and they raised $2.5 million in investor funding. And if you looked at their books in accrual, just by looking at the revenues that were coming in from monthly membership fees versus all of their operating expenses, rent, utilities, et cetera, staff, payroll, they actually were losing $50,000 to $60,000 a month, even though they had just taken in $2.5 million. So they were flush with cash, but they were burning, right? And so when you're talking about scalability and you're talking about taking on investor money or using loans in order to grow your business, a lot of times what you'll hear in the startup world is something called a cash burn. And what's your burn rate, right? Because these companies are not profitable. They're not generating enough money or cash to cover their expenses. And so they're burning cash, right? And so what is the burn rate? How quickly are you burning it? What's your runway? When are you going to run out of cash? The runway means, when are you running out of cash? You have enough cash to make it 6 months. That's your runway. I have a 6-month runway. So that's a really good couple of good examples of having cash and no profit.
Yeah, excellent examples. And I would just say a few battle scars on the larger scaling a larger company. I had like $1 million in the bank when I started Share on Purpose, and we started investing in concepts. And I wasn't thinking about that rate of return. When was I going to get that money back? When was that cash going to come back to me? And so I was sacrificing the profits, not realizing, again, that profits actually generate the cash, that's how I'm going to pay myself back. I was thinking of exits and I was thinking big and all this kind of stuff, but I wasn't thinking, how do these investments actually generate profit as well as cash? And it's kind of like, my analogy is profit is like oxygen, but I'm sorry, cash is like oxygen, but profit is like blood. Like, you need both of them to be working in order to function. Giuseppe, were you going to add something to that?
I was just going to say that that what you had stated was really important in terms of reinvesting profits. A lot of entrepreneurs, when they first start out, they're all about reinvesting profits, and we all end up paying ourselves last, right? I know that I made almost nothing for the first 2 years of my business, and didn't pay myself. So you also want to be conscious of, generating your profits, but you also want to take the reward of all of your hard work, because if you're going to continue to spin your wheels and do work for free, which is essentially what you're doing when you're totally reinvesting the profits in the business, at some point you're going to burn out, right? So you want to get yourself to profitability as quickly as possible, and you want to be able to reward yourself as quickly as possible. And remember to do that.
Bingo. Yeah. And then on a smaller scale, I would say that knowing your cycles piece, you know, when the cash comes in versus when the expenses come in, when you need to get paid, setting money aside for taxes, all of those things you have to know. And you know, conscious entrepreneurs tend not to be as sophisticated financially, not everybody, so please don't take that as a judgment. It's not that, but we tend to want to like ignore this piece, and you can't. You have to understand how your business generates profit, and you have to understand where and when that cash is coming in order to build a sustainable business so you can make a bigger impact. Any other questions? Anthony, that was a great one. All right, everybody. Thank you, Giuseppe, so much. Really appreciate what you've shared today. This recording will be on our YouTube page, and it will also be in the core. And remember, you can check out Varo Team on the partner page for Shiftco. For those of you that are not Shiftco members, you can reach out to Giuseppe directly on his LinkedIn page. And we'll make sure that he has your contact information as well. Thanks, everybody. We appreciate it. And again, Giuseppe, thanks for sharing your wisdom.
No problem. Have a great day, everyone.
Thanks. So long.